Well, it was another wild day on Wall Street. In focus today was, of course, some of the trade tariff news out of the steel and aluminum industries. In fact, we're inching closer and closer to a potential global trade war on our hands here. We had the Prime Minister in Canada come out with some retaliatory remarks towards the United States today. And of course, some of the areas that got hit the most were those that use a lot of steel and aluminum, things like Boeing airplanes, also Caterpillar tractors. And in our trade application example today, I want to focus on another stock that is in the consumer staples space, but it did get also hit to a degree on some of that news regarding aluminum. So kind of a sneaky play there, but I feel like the stock might be a little bit overdone to the downside, so we might try to take advantage of a bullish trade on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's May 31st, 2018. Well, first of all, I want to welcome you in if you're new to watching these videos. You can remember to subscribe to our YouTube channel. You can also comment on it. You can give us a thumbs up if you'd want us to continue to do these on a day-to-day basis here. We always love hearing from our audience. Of course, don't forget to subscribe to our YouTube channel. You can also find out how to sign up for our email distribution list by looking in the description area down below the YouTube video itself. Now, in addition to YouTube, David and I are also heavy users of Twitter. We would encourage you to follow us. My handle is @BrandonVanZee, all one word. And we also pin our Market Outlook tweet to the top of our Twitter profile whenever we each do these videos. So we would highly encourage you to go out and like and retweet, which you can see on the logo there. The retweet button is just the one that has the arrows chasing each other around, and the like button is just the heart. That gives us a sign that you want us to continue to do these free videos for you on a daily basis. Now, in addition to Twitter, we are also on Facebook. We have a presence there through our group, so we'd invite you to join us on Facebook as well. We've got about 1,000 of you that join us on a regular basis in that particular forum. You can see the web address on the screen in front of you. All right, with that, let's go ahead and do a little bit of analysis on the market. Again, as mentioned in the intro, we had quite a day, pretty aggressive day. We were down 0.69% on the S&P 500. Of course, it could have been worse considering some of the news that was out there. We'll talk about the Dow here in just a little bit. The Dow was struggling a little bit more, but the S&P 500 is a little bit broader measure of the overall market since it does contain 500 stocks. So you might be wondering, okay, well, what does the price action dictate as far as posture is concerned? Now remember, when we're setting our posture using what's known as the market forecast indicator, which you can kind of see pulled up on the screen down below here, what we're using generally speaking is this green line. This is what we call the intermediate term line. And in order to set our posture, what we're looking for is for the price of that green line to be either in the upper reversal zone or trending higher between 20 and 80 if we want to consider it to have a bullish posture. So you can see we're in a very precarious position with this right now. If you can't eyeball the exact number, most of you are probably seeing that that green line is basically touching that black horizontal line there, which will represent that 80 zone. But if you ever needed to know the exact number, remember this intermediate term label up here says 80.63 and falling. So in other words, if it went down even less than 1 point, we would already be bearish. So very precarious. Right now, we retain that bullish posture, but that could fade as soon as tomorrow if we even have a slight down day tomorrow. So just be aware we're on the cusp of that. Now we have had a bullish posture for quite some time. You can see we first got our bullish posture on this candle right here. It's easy for my eye to identify that because remember the background color of the chart will be shaded green whenever we get that bullish posture using that intermediate term line on the market forecast with this particular chart setup. For those of you that are following along at home, this is chart 4A. And so it was on this candle right here where we had that green line rising from that prior day where it was falling. So it started rising right there, gave us that bullish posture. And that would have been back on May 4th. So remember, a lot of people kind of refer to May as a difficult month, and many of you have probably heard of the term sell in May and go away. Well, you can see largely May has been a good month, at least this time around for stocks. Now, hard to say whether the end of May is quite as nice as the beginning of May, but at this point, everybody who sold at the beginning of May has probably been waiting in the wings, a little bit regretful watching the markets drifting a little bit higher despite the choppiness we've seen over the last 3 days or so. So at this point, we continue to have that bullish posture. I'll add one more intriguing element to it in that we have what's known as a bullish intermediate confirmation signal on the S&P 500 right now. Remember, that occurs when we have a bullish posture on the intermediate term line, which I've already mentioned that we do currently. But that has to be joined on the same day as that red line in the lower reversal zone. That red line is referred to as the momentum line. And typically it's kind of known as a buy the dips type of a mentality out there. Now, one thing that we have kind of identified in the past is that while the blue near-term line is not technically part of that bullish intermediate confirmation signal, what we've noticed is that those signals are generally a little bit more valuable when we have that blue line between 50 and 20 on the day when we're receiving that bullish intermediate confirmation signal. As you can see right now, this blue line is hanging out at about 72.02, so clearly it's not below 50 at this point. So while it's true we have a bullish intermediate confirmation signal, it's not one of those that we would consider to have an ideal setup at this current time. Let's go ahead and take a look at a couple more charts here. Let's go over to chart 4B at this point, so that way we can look at the market forecast indicator on all 4 major U.S. markets here. And you'll notice that the Dow Jones was down over 1% today. So that's what I was kind of mentioning before, that blue chip average really suffered today. And again, some of those stocks I rattled off in the intro there, Boeing and Caterpillar, of course, those are big Dow Jones industrial types of names. And so they're going to really struggle when the world seizes up on fears of a global trade war. It's those mega cap companies within the Dow Jones that are really the most at risk. You know, if you have a mom and pop retailer that only does business in the United States, they're probably going to suffer a little bit less than somebody who's doing business all over the planet. So that's the fear of the market right now. Whether that's rational or not, we'll find out in due time. But right now, traders are selling first, asking questions later when it comes to those mega cap international companies within the Dow. So you will notice right here that the Dow of all of our charts is the only one that has this pink background kind of behind our candles right now. And that's just a reminder that the posture using that intermediate term line on the Dow Jones is actually already bearish. It's been bearish for a couple of days at this point. The other 3 indices continue to have bullish postures. The NASDAQ and the Russell will likely continue to have a bullish posture for another couple of days at a minimum, but it's that S&P 500 that I mentioned before that could be just as soon as tomorrow when we see a posture shift back to bearish. We'll just have to see if we get a bounce or not. But the other thing I'll point out is that we do have a bullish intermediate confirmation signal on the NASDAQ today as well. Same thing as the S&P 500 where you don't have that blue line in the perfect position of it, but we do have a bullish intermediate posture on the NASDAQ combined with that red momentum line in the lower reversal zone on the same day. Let's go ahead and take a look at a couple more charts here. Let's look at the 3 green arrows chart now. These are going to be the same 4 indices here, and we're still looking at 3 months worth of time on this particular chart setup, but the background color of the charts is a little bit different here in this particular case. Now we're shifting our focus to what's known as the 3 green arrows method, and basically what we're looking at, there are 3 different technical indicators that trend traders oftentimes look towards to see if the stock chart is robust or not. And you'll notice right now we have actually 3 red arrows on the Dow Jones. So we have red arrow number 1 when price is below a moving average in this case. That's the 30-day moving average, by the way. We also have a red arrow down below here in the MACD and another 3rd red arrow down below here on the stochastic. So those are your 3 red arrows right there. So that generally is not a positive sign if you want to be bullish on any particular chart. Now the other 3 charts you'll notice have white backgrounds and over the current candle. And what that means is that we have mixed signals. We have a mix of green and red arrows at this particular juncture. So, you know, we're starting to see some stresses on the marketplace right now. And obviously the news isn't doing a lot to help us, at least if you appreciate global trade. Let's go ahead and take a look at our next chart setup. This is going to be our longer term chart. I like to look at this on Thursdays in particular because David usually does the video on Friday, and since we're close to the end of the week, it's a little bit more helpful than if we're looking at the beginning of the week. Remember, this particular chart setup right here is 3-year weekly. You can kind of see that listed in the upper left there, 3-year weekly. And so what that weekly stands for is the aggregation period of the candle itself. So when you're looking at a weekly candle chart at the beginning of the week, it's maybe a little bit less useful than when you're looking at the end of the week, with the idea being we're close to formulating that candle. Now, just as a heads up, remember, tomorrow will be the payroll number. That's usually a very big number and has the ability to affect the stock market. So we could see a big movement either up or down. So maybe this Thursday, we're not quite as close to the close of a candle as we normally would be, because we have that possibility of a big movement tomorrow to really affect the shape of the candle. But what we're looking for on this particular setup right here, we call this the 1040 crossover method chart. What we're looking for is crossovers of the moving averages themselves. The orange line represents the 10-period exponential moving average. The blue line represents the 40-period exponential moving average. As you can see, in all 4 of our major US indices, we've been bullish for over 2 years. The last time we had a crossover was way back here on the Dow Jones, way back here on the Russell 2000, way back here on the NASDAQ, and way back here on the S&P 500. So what we're looking for are tightening of the moving averages themselves. And as you can see, the one that comes closest to threatening our potential crossover in the future right now is the Dow Jones. You can see that this MACD2 line that we have pulled up down below here is the closest to zero compared to the other ones on the board. You can see the Russell 2000 has been the standout performer. We did hit an all-time high in the Russell 2000 just yesterday, so that's part of this week's weekly candle, of course. And you can actually see the MACD2 line rising a little bit on the Russell 2000 right there, signifying that this orange line is separating itself further away from the less sensitive blue line there. So Russell 2000 is the place to be. We've talked about that ad nauseum for the last couple of weeks. The idea there being they're going to be less affected by any sort of global trade wars. You're finding that the US dollar has been really strong recently. You know, your mom and pop operators in the United States, the small cap companies, are going to have less of a disadvantage when the dollar is as strong as it has been. So there's a couple of themes there that's playing into the hand of the small cap arena right now. Let's go ahead and take a look at some 12 grid analysis now. And so the first set of 12 grids here is going to be our Intermarket Analysis 12 grid. As a reminder of what we're looking at with the background colors on these, when you see the green background colors, it means that we have a bullish intermediate term posture using the market forecast indicator. If you see a red on any of these 12 grid backgrounds, it means that we have a bearish intermediate posture on those. So as we look at this first set, you know, you'll notice a smattering of green and red, and that's by design. Remember, this Intermarket Analysis 12 grid right here is going to contain kind of a smorgasbord of different trading themes, including commodities, volatility, bonds. You know, it's a wide variety of things. So we oftentimes will find deviation in postures here compared to when we start looking at some of the 12 grids that are only focusing on stocks. So one thing that I will point out is that the volatility index, so the VIX is the chart in the upper left here. I'm actually surprised this was not up a lot more today. The VIX was only up 3%. That's almost a non-event for that particular security, especially considering some of the news. So that may be one feather in the cap for the bulls. Yes, we did have a pullback of 1% in the Dow today, but you're not sensing real fear out of the market yet, at least according to the options market. If this were to be considered a true potential of a global seizure of trade, I think the VIX would have been up a lot more. So I think the options traders are still thinking that calmer and cooler heads will prevail, and some of these disturbances we've been seeing in the market here recently will work themselves out. But every day brings a new news story, so we'll continue to keep our eyes on the situation there. As we look at some of the other graphs here, be aware that some of the bond markets have really been moving here recently. So you're seeing muni bonds really popping off of that moving average here recently. We talked last time about how TLT had just a fantastic response to that oversold cluster signal right there, skyrocketing higher. It was down a little bit today, but bonds are elevated right now. Of course, that plays into the hand of preferred stocks as well. You can see PFF has had a nice little bounce here recently as well. We actually talked about preferred stocks a little bit today in my dividend growth investing class. One of the stocks we analyzed was issuing preferred stocks, kind of raising capital in a sneaky way that not a lot of investors will recognize. And so for those of you that are premium subscribers to Market Scholars, I would encourage you to go back and watch the recording for my dividend growth investing class today. All right, let's go ahead and take a look at our next set of 12 grids. This next one will be our foreign stock markets 12 grids. And of course, it's not just the United States that's getting caught up in some of this news. There are reactions across the globe, especially when we're basically the big fish in the sea here in the United States when it comes to global trade. And so there can be reverberations all over the place. But as we look at this particular group of 12 international country equity indexes here, what sticks out to me first off is that there's only 2 bullish charts on the board, and those don't look particularly enticing. India for sure is a little bit of a dicey situation. Yes, you do have the intermediate term line at 29 and rising, so technically that is a bullish posture, but just looking at the price action itself, while we did have a very nice bounce over the last week and a half, where we find ourselves is just at the underside of a falling moving average. So I don't think I would necessarily be overly excited about bullish trades in India quite yet. Israel down below looks a little bit better, but even that chart is not a home run. We had a nice W pattern down there in Israel that we were able to get up and over that midpoint. So that's generally perceived as a positive sign, but we're still below some of these higher levels that we were trading at on EIS back over here on March 13th. The rest of the charts on the board are bearish. And some of those charts look worse than others. We've been talking a little bit more about Brazil here recently. I guess there's been some strikes there in Brazil. They had some oversold cluster signals recently. We got a stopping of the bleeding. So I talked about that 2 days ago when we got this one, but the bounce back has not been significant. So for those of you that did play that bullishly to the upside, at least you're not losing money at this point, but it certainly hasn't been a windfall of cash for you either. So it just doesn't seem like the bulls want to step into Brazil quite yet. Then we have other charts like South Africa down below here that continue to struggle as well. So not a whole lot to get excited about on the international front at this point. So let's turn our attention to the US sectors 12 grid now. And here you can see we're starting to get a lot more bearish postures as well. The S&P 500 retains its bullish posture for right now, but most of the sectors within it, which are the 11 trailing charts after it, have bearish postures. The holdouts right now are technology and discretionary, along with utilities and real estate. And remember, the S&P 500 is kind of pushed around by technology more than any other sector right now, simply because the S&P 500 is a market cap weighted index. And right now you've got about 3 out of the top 4 companies in the S&P 500 that are technology companies. So, your Apples and your Googles and your Microsofts and your Facebooks, those are some of the biggest players out there within the entire market, and they all happen to be part of that technology space. So when you see a lot of sectors in kind of a bearish posture right now, but the S&P 500 is not, a lot of times the reason for that is because technology is remaining strong, and that's still the case. Notice that technology was actually up today. Somewhat surprisingly, technology was up 2 pennies today with XLK. Most of the other sectors, of course, were down on the day. In fact, as I look at the chart, the only other one that was up was down below with utilities. It was up about 16 cents today. That one makes a little bit more sense. Oftentimes when we have kind of a risk-off environment like we did today, money does drift towards some of those perceived safe havens, like the monopolistic characteristics of those utility companies that are out there. But otherwise, it's looking somewhat uglier as the days go on here when it comes to postures using the market forecast indicator itself. So with that, let's go ahead and tackle our trade application example for the day. One of the things I did want to point out is if I come over here to the sectors and just see how they've done on a daily basis, notice that the consumer staples were the worst performer today, down 1.6%. The best performer was utilities. So the utilities, as I mentioned before, makes a lot of sense. The consumer staples a little bit more of a head scratcher. Now, it is true that a lot of consumer staples are global players, but not a whole lot of them use a lot of steel and aluminum. So that's where we have a bit of a head scratcher. If we take a look at some of those movements within the consumer staples space, you can see Kimberly-Clark was down 4% today. Clorox was down 4% today. There's probably not a lot of steel that's being used in those particular companies. Now, obviously, they're going to have steel in their factories and warehouses and different things like that. But the actual commodity that's being sold in the case of Kimberly-Clark is oftentimes lumber and trees and forestry, right, to make your Kleenexes and your other paper products. So kind of suspicious to see some of them getting beaten up the way that they have. But the one stock that I wanted to focus on for the trade application example here today was Hershey's. And I don't know if I can see Hershey's right off the bat. Oh yeah, there it is. Hershey's, I'm kind of pointing at it right there. You'll notice Hershey's was down 1.7% today. So it struggled along with a lot of those other areas of the consumer staples. But remember, Hershey's actually does have a slight built-in portion of what they sell relating to the aluminum space. And that's, of course, the Hershey's Kiss, right? Who doesn't know about the Hershey's Kiss? It takes you back to grade school and handing out your Valentines, right? Well, of course, most of you are aware that Hershey's Kiss are wrapped in that aluminum or tinfoil or whatever it is that they use there. But that's the type of thing that could actually be impacted by some of these tariff news that we're starting to hear about. So it struggled today, and maybe it deserved to struggle given some of that, some of those resources that they use for their actual operating business. But what excites me about Hershey's is this. I'm going to come over here for this discussion real briefly. I'm going to come over here to chart 3A for those of you that are following along at home. This is our dividend stair-step chart. And so when we pull this up, first of all, let me type in the ticker symbol Hershey. It's just HSY. Notice that when we kind of look at this dividend stair-step, it's telling us different things. First of all, what we're seeing here with this orange stair-step is telling us where the stock has typically found some support in the past based off of some of those average high yields that investors have been willing to give Hershey's in the past. So for Hershey's, their average high yield is 2.84. Remember, this is a number that is different for every single dividend-paying company. So specifically for Hershey's, when you get a yield that's close to 2.84%, that's typically a time that has been in the past a good time to be a buyer of that security. Well, you'll notice that after today's price breakdown to close to $90 per share, our yield is now 2.91%. Remember, when price goes down, yield goes up. That is oftentimes a benefit for those of you that want to structure a long-term buy and hold income-oriented portfolio. Now, a lot of times I'm shooting for a 3% yield. Sometimes I get it, sometimes I don't. This is one of those unique times where some of you might already be buying Hershey's, and I wouldn't hold it against you at a 2.91% yield. But for those of you that are trying to hold out for a 3% yield, that's what this blue line represents here. And that blue line can be adjusted for those of you that are premium subscribers to Market Scholars and have gone through my tutorial. You guys can go in behind the scenes on the ThinkScript itself to change that to a different number than 3%. But I myself do like to look for those 3% yielders. So where we're at right now, price action wise, is right here. We're below the orange line, meaning that for this particular company, we're already at attractive levels. But on a historic or on an absolute basis, for those of you that like to see at least a 3% yield, it would need to get down to this blue line. Now that blue line is at 87.47. You can see that kind of up here. I'm circling it within the blue label itself, which of course is color coordinated with that blue dividend stair-step line down below. So we're in that kind of place where I don't feel bad about buying Hershey right here, but I'd sure like to hold out for just a little bit more. The only problem is I don't know if we're going to get a little bit more of a pullback. So this is an interesting time to be a seller of a put that can put us in that position where if the stock does continue to come down, we can buy it for a 3% yield. And if it doesn't, let's say it does start catching some stability and start bouncing from here, then at least we get to keep the premium that we sold going into it. So that's kind of the idea here with Hershey. So keep that number of 87.47 in the back of your mind as we now come on over here to the trade tab itself. Type in HSY and paper money up there at the top. And for this, you'll notice that my initial instinct is to go to the monthly contracts here with the July contracts, but my problem is that we have $5 between the strikes. A lot of times what you can do is you can look at the weeklies. In this case, I'm going to look for something close to 30. We've got 29 days left on those June weekly contracts right there that I'm kind of pointing at. So I'm going to open up that set of contracts. And here you'll notice we have 50 cents between the strikes. So that allows us to customize our trade a little bit better. And where I'm going to focus my attention is looking for a return on risk of at least 1%. That's what I usually shoot for when selling puts. So that leads me to the $88 strike. Now you'll notice that the bid is 78 and the ask is 98. This is not something that attracts a lot of options traders. So be aware, for some of you, this might not have enough liquidity for you. But remember, our goal with selling a put doesn't require a lot of liquidity, because for a lot of us, when we sell a put, we're not actually looking to exit the trade later. We're not looking at it as an income producing strategy per se, as much as we're actually trying to acquire a high quality stock at a lower price. Now, I'd love to buy Hershey's at a price lower than where it's at right now, and $88 makes a lot of sense because, as you can see, we will likely put our trade in at 88 cents. You can see the ask is 78. I'm sorry, the bid is 78, the ask is 98, so the mid price right now is 88, and we're hoping to get filled right about there. Now, remember, if we get filled at 88 cents, we could take $88, which is the strike price that we're going to be selling, subtract out 88 cents, which is the premium we'd be receiving, and our true break even would be $87.12. Now remember, my number I just mentioned to you a moment ago, which was 87.47, is where we would need to be in order to have a 3% yield on Hershey's. So if we were to get filled, our true break-even price would allow us to attain a 3% yield. If it doesn't go down to that level or below, then we'll still keep that 88 bucks that we're going to take in when we sell this trade. So with that, let's go ahead and do this. We're just going to do one contract just to highlight the idea. So I'm going to go ahead and just click on the bid price. I'm going to change the price down here because remember, these are wider spreads right here in the after hours session. So I am going to change it to 88 cents. On Hershey's, again, we're doing the weekly contract, the $88 strike. I am going to change that to a good till cancel order in case we don't get filled on that tomorrow. Confirm and send. Review this one last time. We'll send that in and see how we do with it. All right, well, I want to thank you for joining me here tonight. Another interesting and volatile day on Wall Street. A lot of news stories out there, everything from the trade tariff talks to what's going on in North Korea. We even had some interesting news with Lululemon after hours on their earnings announcement. We had some interesting news on GM here today, kind of getting an investment from SoftBank. And then, of course, tomorrow we got our payroll numbers. So a lot of things going on news-wise that can affect the markets. The main thing is keep a cool head in this business. Nobody ever made money panicking. And so keep a cool head. Stay tuned to these videos. We'll do our best to kind of highlight some of the most important elements of the market on a daily basis. Remember, if you get value out of this video, go over to Twitter. It'll be pinned to the top of my timeline. Go ahead and click like and retweet to let us know that you appreciate these videos and you want us to do them again in the future. So that's it for me for the week. David should be with you tomorrow. So I will see you guys again next Tuesday. So with that, have a great rest of the night. Best of success with your trades and your investments. Goodbye for now.